Karen has $144,000 sitting in cash. Robert has $36,000. They are both 52 years old. They both make the same income. They both have the same monthly expenses. They both want to retire around 67. And if you asked Karen why she keeps so much money in cash, she would not say it is because she is bad with money. She would say the opposite. She would say, I remember what happened in 2001. I remember 2008. I remember people losing jobs, losing homes, losing retirement accounts. I remember watching adults around me realize that the safety they thought they had was not real. And honestly, Karen has a point. Because for a lot of Gen X, money does not feel like a game. It feels like a bunker. It feels like something you build because deep down, you are waiting for the next thing to break. Robert sees the same world differently. He also wants safety. He also remembers the crashes. He also knows retirement is getting closer. But Robert keeps 6 months of expenses in cash and invests the rest. Karen thinks Robert is taking too much risk. Robert thinks Karen is paying too much for safety. And Teacher Ben is about to run the math. Because the question is not whether Karen is responsible. She is. The question is whether her version of safety is quietly becoming the thing that keeps her working longer. This is the real finance math. Generation X is usually defined as Americans born between 1965 and 1980. Which means in 2026 they are roughly in their mid-40s to early 60s. That matters because Gen X is no longer talking about retirement as a distant idea. For the oldest Gen Xers, retirement is not a theory anymore. It is on the calendar. And that is where the psychology changes. When you are 28, a market crash feels like a buying opportunity. When you are 52, a market crash feels like a warning shot. When you are 58, a layoff does not feel like a temporary setback. It feels like a countdown. And this is why Gen X money behavior can look strange from the outside. They may be independent, skeptical, allergic to hype, and deeply uncomfortable trusting institutions. They watched pensions fade, 401ks become the default, companies restructure, housing explode, college costs rise, and financial experts get things wrong in public. So when someone tells Gen X, just invest more aggressively, a lot of them do not hear advice. They hear a young person who has not been punched yet. But here is the uncomfortable part. Fear can protect you from one kind of disaster while quietly creating another one. That is the part nobody likes to calculate. So let's make this fair. Karen and Robert are both 52. They each earn $110,000 per year as a household. They each spend about $6,000 per month, including housing, food, insurance, transportation, utilities, family support, and everything else real life requires. That means 1 year of expenses is about $72,000. They each have $150,000 already invested for retirement. They each invest $1,000 per month going forward. And they each want to retire at 67, giving them 15 years. Now, here's the only difference. Karen keeps 24 months of expenses in cash. That is $144,000. Robert keeps 6 months of expenses in cash. That is $36,000. The difference is $108,000. Karen keeps that extra $108,000 in cash because it helps her sleep. Robert invests that extra $108,000 in a broad, diversified portfolio because he believes 15 years is long enough to let part of the money grow. For the sake of the comparison, we are going to assume the invested money earns 7% per year on average over the long term. We are also going to assume the cash earns 2% per year after taxes. Those are not predictions. They are modeling assumptions. Your actual result depends on interest rates, taxes, investment returns, inflation, job stability, health, and whether you panic at the worst possible time. But the point is not to pretend we know the future. The point is to reveal the price of each choice. At first, Karen looks smarter. And emotionally, it is not even close. Karen loses her job. She can cover 2 years. A recession hits. She does not have to sell investments immediately. Her adult child needs help. She has room. The roof leaks. The car dies. Medical bills show up. The company cuts bonuses. Karen can breathe. That is not irrational. That is power. And this is where people get the conversation wrong. They act like cash is stupid. Cash is not stupid. Cash is control. Cash gives you time. Cash stops a bad month from becoming credit card debt. Cash stops a layoff from becoming a retirement account withdrawal. Cash stops stress from making decisions for you. The problem is not cash. The problem is when every dollar becomes emergency money. Because if every dollar is treated like it might be needed tomorrow, then no dollar is allowed to work for 10 years. That is where the math changes. Let's look at Karen first. She has $150,000 invested already. She adds $1,000 per month for 15 years. At a 7% average annual return, her retirement investments could grow to roughly $731,000. Her extra $108,000 in cash, growing at 2% after taxes, could become roughly $145,000. So between the invested account and the extra cash, Karen has about $876,000 from these pieces of the plan. That sounds strong, and compared with many households, it is. According to Transamerica Institute's 2025 retirement research, Gen X workers have an estimated median of $107,000 in total household retirement accounts, and only 25% have a written retirement strategy. So Karen is not careless. She is ahead of many people. But now let's look at Robert. Robert also starts with $150,000 invested. He also adds $1,000 per month. So his base retirement account also grows to about $731,000 under the same assumption. But instead of keeping the extra $108,000 in cash, he invests it. At 7% for 15 years, that $108,000 becomes roughly $298,000. So Robert's total is about $1,029,000. That is a difference of about $153,000. Same income, same age, same starting retirement account, same monthly contribution, same retirement date. The only difference is how much money was locked inside the emotional safety zone. Karen did not lose money. She lost growth. And that kind of loss is harder to feel because nothing bad happens in the bank account. The balance does not go down. There is no scary red number. There is no headline. There is no crash. There is only a future number that never arrives. That is why too much cash can be so deceptive. It feels safe every month. But after 15 years, the safety may have quietly cost the equivalent of several years of retirement withdrawals. If you used a simple 4% withdrawal rule, a $153,000 difference could represent more than $6,000 per year of potential retirement income. That is $500 per month. Not from working harder, not from earning more, not from winning the market, just from not letting fear overprotect money that had enough time to grow. And for Gen X, that matters because time is still there. But it is not unlimited. A 35-year-old can make a mistake and still have 30 years of compounding. A 52-year-old can still recover, but the margin is smaller. A 60-year-old can still make smart moves, but the math becomes less forgiving. This is why the emotional story and the financial story are fighting each other. Emotionally, Karen says, "I cannot afford another disaster." Mathematically, Robert says, "I cannot afford to protect every dollar from every possible disaster." And Teacher Ben would say both of them are seeing part of the truth. Because Karen is right that risk is real, but Robert is right that avoiding risk completely creates a different risk. The invisible cost is not just lower returns. The invisible cost is delayed flexibility. It is the extra year of work. It is the smaller retirement income. It is saying no to travel at 68 because too much money sat idle at 52. It is keeping a giant emergency fund while the retirement account is still not large enough to support the life you actually want. And here is where the Gen X mindset becomes important. Many Gen Xers are not saving like optimists. They are saving like survivors. And when you save like a survivor, you do not ask, "How do I maximize wealth?" You ask, "How do I make sure nobody can destroy me?" That instinct comes from somewhere. It comes from layoffs. It comes from parents who were financially stressed. It comes from watching the housing market collapse. It comes from seeing retirement shift from employer responsibility to personal responsibility. The Federal Reserve reported that among non-retirees ages 45 to 59, 73% had a tax-preferred retirement account, and 42% felt their retirement savings were on track. Among non-retirees 60 and older, 74% had a tax-preferred retirement account, and 50% felt on track. That means a lot of people have accounts, but far fewer feel safe. And that gap is the story. Because having a retirement account is not the same as believing retirement will work. Having a 401k is not the same as trusting the market. Having savings is not the same as having a plan. And this is why Gen X can sometimes do something that looks contradictory. They may be worried about retirement, but still keep too much in cash. They may know they need growth, but still feel unable to invest more. They may understand inflation intellectually, but emotionally prefer a bank balance that does not move. They may distrust Wall Street, distrust employers, distrust politicians, distrust Social Security, and still be expected to confidently manage a 30-year retirement plan mostly on their own. That is a lot to ask from a generation that was handed the steering wheel halfway through the road trip. Now, to be clear, this does not mean Robert is automatically right for everyone. This is not a video telling a 59-year-old single-income household with unstable employment to keep only a tiny emergency fund. That would be reckless. The goal is not to shame cash. The goal is to separate cash by job. Teacher Ben would put it this way: money needs a job title. Some money is emergency money. Some money is short-term goal money. Some money is opportunity money. Some money is retirement money. The mistake is giving every dollar the same job title. Protect me from disaster. Because once every dollar has that job, your future has no employees left. So here's a better way to think about Karen's situation. Her first 6 months of expenses in cash are not the problem. That is $36,000. That money protects her from normal emergencies. The next 6 months might also be reasonable, depending on her job, health, family obligations, and risk tolerance. Now she is at $72,000. For some Gen X households, that makes sense. But once Karen is holding $1,824, or 30 months of expenses in cash while also feeling behind on retirement, the question changes. The question is no longer, is cash safe? The question is, safe from what? Safe from a layoff? Maybe. Safe from market volatility? Yes. Safe from inflation? Not always. Safe from outliving your money? No. Safe from needing to work longer? Maybe not. Safe from regret at 67? That depends. This is the number Karen did not see. Her cash protected her from a short-term emergency, but part of it may have exposed her to a long-term emergency. The emergency of arriving at retirement with too much money that stayed safe, and not enough money that grew. And that is the strange trap of middle-age money. At 25, people often take too much risk because the future feels far away. At 52, people often take too little risk because the future feels too close. But retirement is not one date. Retirement is not just the day you stop working. Retirement is a 20-year, 25-year, or 30-year financial project. A 52-year-old is not investing for next Tuesday. A 52-year-old may be investing for age 70, 75, 80, 85, and maybe beyond. That does not mean everything should be aggressive, but it does mean the entire portfolio cannot be built around tomorrow's fear. Now let's make the math even more personal. Imagine Karen gets to 67. She looks at Robert and says, "You ended up with about $153,000 more because you invested the extra cash." Robert says, "Yes." Karen says, "But I slept better for 15 years." And that is a real point. There is a psychological return on cash. If cash keeps you from panic selling, it has value. If cash keeps your marriage stable during job loss, it has value. If cash lets you help a parent without debt, it has value. If cash prevents a 401k withdrawal at the bottom of the market, It has value. Not everything valuable shows up in a compound interest calculator, but the reverse is also true. Not everything expensive shows up in your checking account. Karen's extra cash gave her emotional comfort, but Robert's invested money gave him future flexibility. So the real question is not, who is smarter? The real question is, which fear are you solving for? Karen is solving for the fear of sudden loss. Robert is solving for the fear of slow shortage. Both fears are real, but only one of them usually gets measured. This is where Teacher Ben would draw a line on the board. On the left side, protection. On the right side, growth. Too much growth with no protection creates fragility. Too much protection with no growth creates stagnation. And the goal for Gen X is not to become fearless. The goal is to stop letting old fear manage new money. Because the financial world Gen X grew up and shaped them. But it does not have to control every decision they make now. Now, when does Karen's larger cash position actually make sense? It can make sense if she works in a volatile industry. It can make sense if her income is commission-based. It can make sense if she owns a small business. It can make sense if she has major health uncertainty. It can make sense if she supports aging parents or adult children. It can make sense if she is within a few years of retirement and wants a cash bucket to avoid selling investments during a downturn. It can make sense if her risk tolerance is so low that investing the money would cause panic decisions later. And that last one matters, because the best portfolio on paper is useless if you cannot stay invested in real life. Robert's strategy only works if Robert actually behaves like Robert. If he invests the $108,000, watches the market fall 25%, panics, sells, and then waits years to get back in, he may end up worse than Karen. Behavior is part of the math. That is why this video is not saying, cash bad, stocks good. That is too simple. The real message is this: cash is a tool. Fear is a signal. But neither one should be the entire plan. And for Gen X, the plan has to become more deliberate now. Not someday. Now. Because Transamerica's research also found that 39% of Gen X workers expect to retire at age 70 or older, or do not plan to retire, and 56% plan to continue working in retirement. For some people, working longer is a choice. For others, it is the backup plan. But a backup plan that depends on perfect health and continued employability is not really a plan. It is a hope wearing a work badge. And Gen X knows better than most generations that employers do not always cooperate with your timeline. So if you are Gen X and you feel behind, the answer is not to shame yourself. Shame is not a strategy. The answer is to classify the money. First, decide how much cash you truly need for emergencies. Not how much makes fear go silent forever. Fear will always ask for more. Decide based on your life. 3 months might be enough for a dual-income household with stable jobs and low debt. 6 months might be reasonable for many families. 12 months might make sense for unstable income, health concerns, or heavy family obligations. More than that can still make sense, but it needs a reason, not just a feeling. Second, separate short-term money from long-term money. If you need the money in the next 1 to 3 years, it probably does not belong in volatile investments. If you need it in 10 to 15 years, keeping all of it in cash may create its own danger. Third, increase the money that is working. That may mean raising retirement contributions. It may mean using catch-up contributions when eligible. It may mean investing through a taxable brokerage account after tax-advantaged accounts. It may mean paying down high-interest debt first. It may mean working with a planner. It may mean simply moving from fear-based saving to rules-based saving. But the shift is important, because Gen X does not need motivational nonsense. Gen X does not need someone yelling about abundance. Gen X needs a clear plan that respects what they have lived through but does not let the past steal the future. And that brings us back to Karen and Robert. Karen was not wrong to want safety. Robert was not wrong to want growth. But Karen made one mistake. She never asked when safety had become excess safety. And Robert made one assumption. He assumed he could emotionally survive volatility. That is why the winner is not automatically the person with more stocks. The winner is the person who gives every dollar the right job. Emergency dollars should protect you. Retirement dollars should grow for you. Short-term dollars should stay stable. Long-term dollars should not be trapped by short-term fear. And fear should be heard, but not promoted to CFO. That is the real math, not just the return, not just the cash balance, not just the market chart. The real math is matching the money to the actual risk. Because the danger for Gen X is not that they save like the world is ending. In some ways, that instinct saved them. The danger is never noticing when the world did not end. But their money still behaved like it did. So here is Teacher Ben's final rule. Keep enough cash to survive the storm. But do not keep so much cash that your future never gets sunlight. If this video helped you see a number you were missing, hit the like button, subscribe to The Real Finance Math, and tell me in the comments, how many months of expenses do you think is enough for Gen X? 6, 12, or 24? And if you want to run this exact math with your own numbers, the spreadsheet is linked in the description. In the next video, we'll look at the opposite problem. Why high earners still feel broke, even when the income looks impressive on paper. Because sometimes the problem is not how much you make. It is how much of your future your lifestyle already spent.